All right, today we're going to pull back the curtain on a pretty sophisticated financial product, the Magnum Hybrid Long-Short Fund. We're going to unpack what it is, how it works, and maybe most importantly, who it's actually built for.
You know, it's a question every investor asks themselves, right? How do you potentially grow your money when the market's tanking, not just when it's soaring? Most investments are kind of a one-way street. They work when things are going up. But what if there was a way to find opportunities on the way down, too? Well, that's the big idea we're digging into here.
Okay, so first things first, what is this thing? Let's slice through all that financial jargon and see what's really at its core. So officially, they call it an interval investment strategy. All that really means is you can't just buy and sell it any day of the week like a typical mutual fund. The big selling point here is flexibility. It's designed from the ground up to handle whatever the market throws at it, whether it's good times or bad. And that's a theme we're going to see again and again. Now, that word hybrid in the name, that's super important. This isn't just a stock fund or just a bond fund. Think of it more like a cocktail. It's a strategic mix. You get the potential for growth from stocks, and then the stabilizing effect and income potential from bonds. All right, before we get any deeper, we got to talk about risk. I mean, it's always the first question, right? According to their own paperwork, the fund rates itself as a risk level 2 out of 5. So on paper, it's positioned on the lower end of the risk spectrum. That's their official take based on the strategy. So, okay, we've got a hybrid fund that calls itself lower risk. But what's the point? What's the end game here? What's it actually trying to do for someone who invests in it?
And here we have it, straight from the horse's mouth. The mission is really a two-parter. Part 1, generate a steady, regular income. And Part 2, grow the actual value of your investment over the long run. And that dual goal, that's really the whole sales pitch, isn't it? It's trying to do two things at once. Give you some cash flow for today while building your wealth for tomorrow. That's a really tough balancing act to pull off. And you can bet it's going to need a pretty special strategy to even attempt it. So the big question is, how? How does it try to pull off this balancing act? Let's pop the hood and look at the engine of this thing, the actual investment strategy.
This right here, this is the whole secret behind the long-short name. Going long is what pretty much everyone thinks of as investing. You buy a stock, you hope it goes up. Simple. Going short is the flip side. It's a strategy where you can actually make money if a stock's price goes down. This fund does both. It plays both sides of the coin.
And this is how that hybrid idea actually looks in practice. You can see it's mostly in stocks, right? Somewhere between 65 and 75%. That's your growth engine. Then you've got this big chunk, 25 to 35% in debt. That's for the stability and that regular income we talked about. There's a little wiggle room for things like real estate, but that core mix is the foundation for everything they're trying to do. Okay, so to make all this happen, the fund uses some pretty advanced tools from the financial toolbox. The first one is a big one, derivatives. Don't let the words scare you. They're basically just contracts, like options or futures, that get their value from something else, like a stock. The fund can use these to manage risk or maybe even squeeze out a little extra income. Next up, another fancy word, arbitrage. This one's actually pretty simple in concept. It's all about finding tiny little price glitches. Imagine a stock is selling for one price on one exchange and a slightly different price on another, just for a split second. Arbitrage is about exploiting that difference. Each profit is tiny, but when you do it over and over, it can add up to some very low-risk returns. And the third big tool in the kit is hedging. This one is all about playing defense. The best way to think about it is like financial insurance. You're setting up a side bet that will pay off if your main bets go wrong, helping to cushion the blow and limit potential losses. Okay, so that's the how. It's complicated stuff. But who is this for? I mean, really, who is the target audience for a product like this? Well, the fund's own documents paint a very clear picture. This is not for everyone. We're talking about someone who's in it for the long haul, someone who actually understands and is okay with these complex derivative strategies. And here are the two big ones. You need deep pockets, and you can't be someone who needs to get their money out in a hurry. And when they say deep pockets, they aren't kidding. It's not just a vague idea. There's a ticket price to get in the door. The absolute minimum you can start with is 10 lakh rupees. That one number tells you a whole lot about who this fund is aimed at. And remember that point about not needing your cash right away?
This is what they mean. The fund has what's called limited liquidity. You can't just wake up on a Wednesday and decide to sell. They only process redemptions 2 days a week, Mondays and Thursdays. That's it.
All right, let's move on to what is arguably the most important part of this whole discussion, the risks. With a strategy this complex, you absolutely have to understand what could go wrong.
First up, you've got the usual suspects, the risks that come with just about any investment. You know, stocks are volatile, interest rates move around and can mess with bond prices, and some of the more niche assets might be tough to sell if you need to, fast. But then you have the risks that are specific to this fund's special strategy. Those derivatives we talked about, they're a double-edged sword. They can amplify your losses just as easily as your gains. That hedging insurance, it's not a perfect guarantee. And there's always counterparty risk, which is a fancy way of saying, what if the person or company on the other side of your deal just doesn't pay up?
And just in case there was any doubt, the documents spell it out in black and white. They make it crystal clear. This is an investment with real risks, and that includes the possibility that you could lose some or even all of your original investment. So let's wrap this up and boil it all down. What have we learned? 1, it's a hybrid strategy, playing both offense and defense. 2, it's chasing 2 goals at once, income and growth. 3, it uses some seriously complex tools to get there. 4, it's for a very specific investor with that high 10 lakh rupee entry fee. And 5, probably the most important point, you have to acknowledge the risks, which are real and significant. And so all of this leaves us with a final question, and it's one only you can answer. Now that you see the moving parts, the goals, the tools, the risks, is this kind of balanced but very complex strategy the right puzzle piece for your personal financial picture?